Good morning, good afternoon. Thanks everyone for dialing in and welcome to this webinar presentation of the key findings of the 2018 Institutional Real Estate Allocations Monitor. This is Doug Weil speaking. I'm a managing partner at Hodes Weil & Associates. Shortly after the call, our full report will be available. You can download that at our website, which should be up on the screen at this point, hodeswile.com, or feel free to email us for a request for a copy, or for that matter, with any comments on the material. This call is going to be being recorded and will be available for replay. I'd like to turn it over to Dustin Jones, who will kick off the discussion. Dustin is the director of the Baker Program in Real Estate at Cornell University. Cornell has been our partner in this research project for 6 years, and Dustin will walk through the scope and methodology.
Thank you, Doug. If I may just share with everyone the objectives of this publication that, as Doug has said, we've done now for 6 years. The publication is to establish the most comprehensive annual assessment of institution allocations to and objectives in real estate investments. We analyze trends in industrial capital allocations, assess investor sentiment and conviction toward the asset class, analyze target and historical returns in institutional portfolios. We assess the role of real estate in investment portfolios and gauge the impact of institutional trends on the investment management industry as a whole. We've leveraged the academic resources that we have at Cornell University and the Cornell College of Business, the Hotel School, and the College of Architecture, Art and Planning in partnership with Hodes Weil. And we've relied on the able bodies, graduate students in the Baker Program in Real Estate, both Julian Carroll and Jiwan Park. Our methodologies of participation for this year include 24 questions that focused on portfolio allocations, current and future investments, historical and target returns, investor conviction, investment management trends, environmental, social, and government as well. We launched the survey in May of 2018, this past year, and closed the survey in September of this year. We surveyed approximately 3,000 institutions and had a participation of 208. So that's a participation rate of 7% from 29 countries. And 43 of those institutions that responded had an AUM in excess of $50 billion, 11 trillion in total assets, and 1 trillion in real estate assets. Of the 28 participants, we could break those down. They're from 29 countries. 126 of those countries of the participants are in the Americas, representing 4.7 trillion in AUM, 420 billion in real estate. The EMEA countries had 49 participants, 5 trillion in AUM, 500 billion in real estate. The APEC countries had 33 participants, 1.3 trillion in AUM, and 125 billion in real estate. With that, I'd like to turn the time back over to Doug, who's going to share more of the findings.
Thanks, Dustin. So my colleague Michael Lisa and I will spend about 10 or 15 minutes going through the key findings, and then we will leave time for Q&A. On your screen, you should be able to type in questions, and we will get to as many as possible at the end of the discussion. I would like to take a moment, though, and really thank Dustin for all of his support, as well as the team at Cornell. This has been a 6-year partnership working on this research. Hard to believe it's been 6 years. I think through the collective hard work of the team at Cornell and at Hodes Weil, we've established the Allocations Monitor as the definitive survey covering institutional allocations, objectives, and intentions for the real estate industry. In 2017, we had 5,000 downloads of the report, 31 featured articles written, over 30,000 views of our press release, and numerous citations and other research papers and reports. So we're really proud of this work and the place this survey has in the industry. So turning to the details on slide 5. Actually, I think it says 6 on the screen. Just in summary, what we're seeing is that capital continues to flow to the asset class. Allocations are up, and we expect to see allocations continue to increase over the next 12 months. This is despite our predictions last year that allocation trends would moderate, and we'll talk a bit about why we think that is, why we're seeing continued momentum. Real estate as an asset class for institutions continues to generate strong performance, and we've also seen that investment activity is up. That said, there's a lot of caution in the market today, generally related to late cycle concerns. We're seeing cross-border capital flows accelerate. However, we're picking up, or we're noting a transition of interest from predominantly the U.S. to Europe and Asia, so we'll talk about that. And then finally, third-party managers are the beneficiaries of growing institutional allocations and continued outsourcing of investments, so you're seeing AUM for managers really grow. So just turning to the details, allocations were up specifically to 10.4% in 2018. That's up about 30 basis points over 2017, and importantly up 150 basis points since 2013. Again, this surprised us a bit because we expected to see a slowdown year over year in the allocation, but at 30 basis points, it's squarely in the range of what we've seen for the past 5 or 6 years of 20 to 40 basis points per year. It is important to note, though, that although 30% of institutions are increasing their allocations or increased their allocations in 2018, 30% decreased their allocations, and that's up from 18% that had decreased their allocations in 2017, so that's a pretty notable trend. Going forward over the next 12 months, we expect allocations to continue to rise. Institutions are forecasting an increase of about 20 basis points, and we think this is pretty meaningful. In the past, our survey has been highly predictive of the next 12 months, so we feel pretty good about that number. However, looking at the numbers in a bit more detail, if you focus on the graphs, what you'll note is that Asia, Asia Pacific, and Europe and the Middle East are forecasting increases of 40 basis points, but the U.S., or the Americas, I should say, is actually forecasting no change in target allocations, and we think that's notable. Focusing on current investments, portfolios are growing. Institutional portfolios are really growing at quite a fast pace. So the actual allocation in institutional portfolios is now up to 9.5%, up from 9.1%. That's being driven by the appreciation of the investments themselves, as well as a rise in transaction volumes and an increase in capital commitments to real estate private equity vehicles. When you factor in the denominator effect in that other asset classes are all seem to be performing well, we're estimating that the value of assets held by institutions has increased over 10% year over year, so that's pretty meaningful. That said, institutions are 90 basis points underinvested relative to their target allocation, so there's still a pretty wide gap. It's been plus or minus 100 basis points for the past 5 or 6 years. And approximately 60% of institutions are currently underinvested relative to their targets by an average of 150 basis points. Focusing on returns, real estate continues to deliver strong performance. We saw, or the survey noted, that real estate portfolios delivered an average return of 9.2% in 2017, and that was actually up from 8.7% the prior year. So after a couple of years of trending downward, we saw an uptick in returns. This is fairly consistent with real estate return indices from around the world, where you saw a step up in returns in 2017. We attribute it to the to economic growth, which had been slow in 16 and then began to accelerate in late 16 into 17, and hence better returns in 2017. Importantly, real estate continues to outperform target returns for institutions in their portfolios. Over the past 5 years, institutional portfolios have delivered an average return of 10.3%, which is against a target return of 8.2%. That target return has remained fairly constant over the past few years. We also measure conviction or market sentiment for the asset class. So we ask a series of questions to try and ascertain market sentiment and ask specifically institutions to rate real estate, their view of real estate from a risk-return standpoint, 1 being least favorable, 10 being the most favorable. And this year we saw an actual uptick in sentiment, which surprised us a bit. We had seen a steady decline since 2013, and in 2018 we actually saw a slight uptick. We would characterize that as kind of moderately optimistic / pessimistic, so it's not as if investors are turning optimistic, but it is noteworthy that there was a slight uptick. We think it's particularly surprising because investors continue to cite concerns regarding rising interest rates, asset valuations, and geopolitical risks, in addition to just the overall perception of being late in the market cycle. And then finally, I'll note that conviction was up across all regions, so pretty consistently across location of institution. And then turning to risk preferences, value-add strategies remain the strong preference for institutions. And it's noteworthy that interest in core strategies actually declined for the first time. So we're seeing investors shift their focus to alpha-generating strategies in this low-yield environment. Approximately 90% of institutions are actively focused on value-add strategies, so by a wide margin, the most significant area of focus. And then again, as I mentioned, we have seen the interest in core drop to 63% of institutions, down from 69%. And then finally, I will note that despite the shift in interest in core, if you actually look outside of North America at Europe, the Middle East, and Asia Pacific, core is still the most preferred investment strategy. And in the Americas, it's just 50%. So with that, I'm going to turn it over to my colleague, Michael Lisa.
Thanks, Doug. So now we'll focus on geographic preferences. So we expect that cross-border capital flows will continue to remain strong, led by institutions in EMEA and Asia Pacific, as interest shifts from investment in the US to Europe and Asia. Despite the strong performance of US real estate over the past several years, interest in US-focused investment strategies appears to be waning. This has been compounded by currency hedging considerations for institutions in Europe and Asia, as the US dollar has strengthened considerably year to date. Interest in European and Asian-focused strategies is on the rise, and a notable trend is that APAC institutions have shifted their focus to regional strategies. Now we'll move on to third-party managers. So third-party managed AUM continues to trend upward in 2018. Rising target allocations and an increase in cross-border investing continue to drive the percentage of investors that plan to outsource management of their real estate portfolio investments to third-party managers. It is expected that 85% of new investments over the next 12 months will be allocated to third-party managers. Institutions continue favoring allocating capital to existing manager relationships, as evidenced in Exhibit 14 below. And emerging managers, or first-time fund managers, continue to be at a disadvantage, as only 16% of institutions noted willingness to invest with a first-time fund. In terms of investment product trends, closed-end funds continue to gain favor with institutional investors. Approximately 93% of institutions are actively allocating capital to closed-end funds, which is up from 87% in 2017. While larger investors continue to focus on direct investments, joint ventures, and separate accounts, 89% report being actively focused on closed-end funds, in particular for niche strategies and harder to access geographies. This is particularly the case for smaller institutions that do not have the resources to internalize management functions, as well as for institutions that are allocating investments cross-border. And lastly, we'll touch on ESG. So ESG policies continue to be increasingly important for institutions, and investment managers should take notice. Approximately 39% of institutions indicate that they have a formal ESG policy, which has risen over the past 2 years from 32% in 2016. Responses to ESG, however, vary considerably by type, by size, and by location of institution. European institutions are leading the market in terms of prioritizing ESG relative to their peers, and endowments and foundations are the least likely to be influenced by ESG policies. Larger institutions continue to make ESG a priority, where 61% now are influenced by ESG in their investment decision-making process versus just 36% 2 years ago. So we will continue to track these changes to ESG policies over the coming years. And with that, I'll turn it back over to Doug.
Thanks, Michael. So please submit any questions that you have. We'll be happy to answer them. What do we got, guys? Okay, well, there's a question about scope as to whether we have considered expanding the survey to cover other real assets and infrastructure. And actually, in the past, we had some questions regarding real assets. What we found was, and maybe this is telling, is it was a bit confusing for some institutions because some institutions include real assets and real estate as one allocation and some break it out. So it's very hard to kind of drill down and get to good data, but we'll probably consider adding some questions again next year. So the question is, one of the questions is, why do allocations continue to rise when conviction continues to decline, although, again, it did tick up slightly this year. And I think that real estate is still viewed as a strong performing asset class, particularly relative to other opportunities in institutional portfolios. So whereas there's caution, it continues to be a favorite asset class. I think there's also real value in seen in the yield that real estate generates, potential protection against inflation and inflationary environment, and then also if you believe in economic growth, real estate should perform well. So there's clearly more caution in the market, but the top-down view coming from the CIO is in general more real estate.
So one of the questions that we had was, did you find any preferences or objection to various sectors within real estate? We haven't covered these sectors in the past. It's always something to consider for future surveys, but we've found it difficult to ask people their global preferences by sector around the world.
But I would add to what Michael said is this trend where institutions seem to be shifting their focus, and this is a pretty macro view, not necessarily away from the U.S., but they're starting to consider Europe and Asia-focused strategies as a higher priority. That's a clear trend, and we think that's exacerbated as well by currency hedging. So institutions looking to invest in the U.S. have the added barrier today if they need to hedge back to their local currency, that the cost of hedging is quite high now as the U.S. dollar has strengthened. So there's a question about institutions shifting from equity-oriented real estate investments to credit. In our report, we do cover that, so I can comment on it. Clearly, it's been very topical for the industry, real estate debt strategies, particularly late in the cycle. And there have been numerous headlines about the momentum of capital raisings for a range of real estate funds and other vehicles. So that's a clear trend. But we do note that only 50% of institutions have a specific allocation or capital available for real estate debt strategies, and so it's not quite widespread at the moment, and we don't see a real change year over year in appetite, but we do see continued strength in the strategy. Next question is, how much focus is there on current income versus residual value, terminal value in the market today? And I think the trend that probably answers the question or addresses that question most directly is the shift from core strategies to value add. And what we saw in the survey findings is, and some of the commentary that we specifically got from institutions, is a general concern about the level of cap rates in the market, and the fact that if you are relying on a strategy that is very driven by the going in cap rate and the exit cap rate, at this point in the cycle, with the potential for rising interest rates and pressure on cap rates, that perhaps there's a bit of additional risk in core, and that is contributing to a shift towards value add or alpha generating strategies where something's done to the real estate, NOI, you're seeing NOI growth or an increase in the credit profile of tenancy. So the residual cap rate is important, but less of a factor in the overall return. Yeah, and the final question is noting that appetite for core strategies is going down. I think the question is, are you seeing capital actually taken out of core and shifted to other strategies? And we really did not cover that specifically in the survey, and nothing really indicated that institutions are going to be liquidating core positions and cycling into value add. There have been a couple of headlines of institutions that have done that. What we're expecting to see more, and what we really focus on in the survey, is the capital they have to deploy over the next 12 months, where do they expect to put that? Okay, we'd like to thank everybody for dialing in today. Again, the call has been recorded, so it's available for replay, and our report should be up on our website, or feel free to email us if you'd like us to send a copy. Thanks for your time today.